All right, let's get right into it. Today, we're breaking down the absolute core mechanics of UK taxation for ACCA students, and we're turning it into a fast-paced, exam-ready guide. Now, if you're currently prepping for the TX exam, you already know the examiner absolutely loves testing your ability to navigate the rules around self-employment. So, we're going to strip away all the confusion, act as a bit of a rescue mission for both your sanity and your grades, and focus purely on those high-yield concepts you need to score maximum marks. So here's the ultimate question, right? How exactly do you turn standard accounting profit into taxable profit without falling right into the examiner's traps? Because, well, here's the secret. HMRC honestly doesn't care about your beautifully crafted accounting profit. They want the exact numbers, completely free from any accounting noise. They have their own incredibly strict set of rules about what actually counts as income and what counts as a valid deduction. And knowing the difference between the two, that is exactly what separates a pass from a fail. Okay, here's our roadmap for today. 1. Tackling trading profits. 2. Adjusting your deductions. 3. Mastering capital allowances. 4. Navigating asset pools. 5. Rescuing revenue through loss relief. And finally, 6. Exam traps and fixes. Section 1. Tackling trading profits, earning and adjusting. Okay, so before you can calculate even a single penny of tax, you've got to filter out the noise to arrive at your true taxable trading profit from a trade, profession, or vocation. And before we even start with the math, we have to understand the timing. The basis of assessment is the foundational rule here. It simply states that under the current year basis, your tax profits for the year are equal to the profits of the accounting period that ends in that specific tax year. So for example, if your accounting year ends on December 31st, those are the profits that fall into that specific tax year's assessment. It's literally the anchor for everything else we're going to do. Listen, if you remember absolutely nothing else today, lock this golden rule into your brain. Trading profit equals revenue minus allowable expenses, and standard depreciation is completely disallowed. It's basically your ultimate cheat code for the exam. You start with revenue, you subtract only the things that HMRC actually allows, and you completely strip out standard accounting depreciation. Section 2. Adjusting your deductions. The rule of contrast.
Now, this is where the real heavy lifting happens in the exam. You have to separate exactly what HMRC allows from what they're going to immediately reject. And the contrast here is stark. On the allowable side, HMRC is perfectly happy to let you deduct things like staff wages, rent, business insurance, repairs, well, as long as they aren't improvements anyway, and business mileage. But then flip over to the disallowed side, drawings taken by the owner, disallowed, capital legal fees, disallowed, private expenses, disallowed. HMRC is absolutely not going to fund your personal holiday just because you answered a couple of work emails on the beach. And of course, the biggest trap of them all, standard accounting depreciation, is strictly disallowed.
Section 3. Mastering capital allowances. The big deductions. So, since we just established that accounting depreciation is completely off the table, how on earth do businesses actually get tax relief for their equipment? Enter capital allowances. These guys are the real MVP of tax deductions. They are the official tax depreciation for plant and machinery that legally reduces your taxable profit. You're basically replacing the fake news of accounting depreciation with HMRC's fully approved capital allowances. This is exactly how you get tax relief for the heavy machinery, the office desks, and the computers you buy for the business. Now, get a load of this massive number, £1 million. This is your annual investment allowance, or the AIA. For most plant and machinery, HMRC actually allows you to deduct 100% of the cost, straight away, up to a limit of £1 million. It dramatically slashes your taxable profit right in the year you buy the asset. It's an incredibly generous relief, and you've got to be actively looking out for it in your exam scenarios. Section 4. Navigating asset pools. Sorting your machinery. But as you might guess, not every single thing gets that VIP £1 million treatment. Once you've used up your AIA, or for assets that just don't qualify for it, HMRC gives us two main buckets to sort our assets into. First up is the main pool, which gives you an 18% writing down allowance each year on a reducing balance basis. This is where your standard plant and machinery goes. Then we've got the special rate pool, which drastically restricts your allowance down to just 6%. You'll use this one for long-life assets and integral features of a building. Think of things like a really expensive new air conditioning system. You need to know exactly where to slot your exam scenario assets so you're applying the right percentage every time. Now, when it comes to business cars, the rules are highly specific and honestly highly testable. A car's emissions will strictly dictate your allowance rate. So if it's a low-emission car, meaning 50 grams per kilometer or less, boom, it goes straight into the 18% main pool. But if it's a high-emission car, anything over 50 grams per kilometer, it gets restricted to the 6% special rate pool. You definitely want to memorize these cutoffs.
Section 5, Rescuing Revenue, Loss Relief, the Safety Net. Okay, let's shift gears for a second. We've talked a lot about making money, but let's talk about losing it. Because business doesn't always go according to plan, right? But luckily, HMRC provides a step-by-step safety net to rescue your revenue when you generate a trading loss. And this is the exact flow the examiner is going to expect to see. First, you have current year relief, where you set the loss against your total income of the exact same tax year, which is absolutely great for a quick refund. Second, you can carry back the loss against your total income of the previous 12 months, which is perfect if you had a really high income year last year. And third, if you still have losses left over after all that, you carry forward against future trading profits of the exact same trade.
Now, actually closing down a business is tough, but HMRC does offer a fairly generous parting gift. This special rule is called terminal loss relief. If you happen to make a loss in the final 12 months of trading, HMRC offers a generous relief that allows you to carry that loss back up to 3 years against previous trading profits, starting with the latest year first. It's a fantastic lifeline for a closing business, and trust me, it is a highly testable exam concept.
Section 6, Exam Traps and Fixes, Outsmarting the Examiner. All right, time to expose the most common tricks the examiner uses to trip students up. Here is an absolute classic. The trap, claiming the annual investment allowance on business cars. Do not get caught out by this. It happens all the time. The fix is incredibly simple. Remember that cars are literally never eligible for the AIA, no matter what the scenario implies. You must always allocate them directly to either the 18% or 6% pools based strictly on their CO2 emissions. And that brings us to your golden rule for exam day. Show all workings. Look, the examiner heavily rewards your logic and your structure. Even if you completely panic, press the wrong button on your calculator, and your final tax payable number is slightly off, you can still pass comfortably if you've shown your step-by-step method. Write down your process. Let the examiner actually see your brilliant tax logic at work. Well, we've covered a ton today. We looked at the stark contrast in deductions, the sheer power of capital allowances, the strict car emission rules, and the vital safety net of loss relief. But here is a question to leave you with, to really test what we've learned. If a business buys a high-emission car in its final year of trading, how exactly do capital allowances and terminal loss relief interact? Think about how those rules collide. Keep practicing, let that scenario simmer in your mind, and go take your next ACCA TX exam by storm.